Welcome to Talk Tickers, the podcast that really gets into the weeds on earnings calls for the experienced investor.
That's right.
Today, we're diving into Utz Brands, Inc. They just had their second quarter 2025 earnings conference call.
Yep, reported on July 31st.
And we're going to explore the numbers, obviously, but also management strategy, their vision, and try to figure out, what drove the market's reaction.
Because it definitely reacted. Let's start with the snapshot.
Okay, so the Q2 results, like you said, July 31st. And honestly, the headline numbers, they present a bit of a mixed picture, wouldn't you say?
Oh, absolutely. Mixed is the right word. You had some good, some less good.
So on the earnings side, GAAP EPS landed at $0.12. That's a pretty big drop, 47.8% year over year. Significant.
Yeah, that definitely stands out. And the adjusted EPS, which is what the street often focuses on, came in at $0.17.
Right, and consensus estimates were sitting around $0.19. So a miss there.
Clear miss on the bottom line, yeah. But then you look at revenue.
And that's where the story changes a bit. Revenue was actually strong. $366.7 million.
Which is up 2.9% year over year. And importantly, that beat the consensus estimates. So top line strength.
And digging into that revenue, the core business, branded salty snacks, it's like 88% of their sales, right?
Huge chunk, yeah. And that showed really robust organic growth, 5.4%. So the main engine is still firing.
But the other parts?
Well, the non-branded and non-salty segments, they actually declined pretty sharply, down 11.8% organically. So a real divergence within the portfolio.
Okay, what about margins?
Another bright spot, actually. Adjusted gross margin improved nicely, 220 basis points, bringing it to 39.8%. Management pointed to productivity gains there.
So better efficiency in making the snacks.
Right.
But adjusted EBITDA?
That saw a slight decline, yeah. Down 2.0% year over year to $48.7 million.
So putting it all together, strong revenue beat, good gross margin improvement, but a miss on EPS and a slight dip in EBITDA.
Exactly. And the market's immediate reaction really highlighted that split, didn't it? It felt like the strong top line and the gross margin gains were just completely overshadowed by that EPS miss.
Yeah, it was like, great job selling snacks, but where's the profit?
Yeah.
Okay, let's unpack this more. Despite the revenue beat, despite the impressive gross margin expansion, the market laser focused on the EPS miss and, maybe even more importantly, the revised full-year guidance.
That's spot on. Management revised their full-year adjusted EPS growth guidance down. They're now expecting plus 7-10% growth.
And previously, they were guiding for plus 10-15%. That's a noticeable step down.
It is, and they attributed that downward revision, which was about a 3-cent cut at the midpoint, primarily to two things.
Okay, what were they?
Well, first, higher interest expense. That accounted for about half of the revision.
Why higher interest?
Because the company borrowed more money and they did it sooner than planned. They said this was to fund accelerated productivity programs and, other growth initiatives. So pulling investment forward.
Okay, so borrowing more sooner equals higher interest costs now. What was the other half?
Higher amortization and depreciation. And this was interesting because they spent roughly 70% of the entire year's planned capital expenditure just in the first half.
Wow, 70% in H1. That's definitely front-loaded.
Yeah, a big departure from their usual pattern. Usually it's more back half weighted, so higher D&A hitting the P&L earlier.
Okay, so those two factors explain the EPS pressure and the guidance cut. But like you said, the operational front seemed much more positive on the call. Management was really emphasizing volume-led growth, market share gains.
Absolutely. They didn't just grow revenue, they actually outgrew the whole salty snack category in terms of retail sales. Utz Brands sales were up 3.3%, while the category actually declined 1.5% in that 13-week period ending June 29th.
That's significant outperformance. Taking share.
Definitely taking share. They're getting into more households, too. Household penetration saw a really healthy jump, 220 basis points year over year, reached 50%, half the households.
Impressive. And they talked a lot about their Power 4 brands, didn't they?
Yes.
Especially Boulder Canyon.
Yes. Boulder Canyon was definitely a highlight. Management seems incredibly bullish on it. They noted strong performance in both core markets and their newer expansion areas.
And they see big potential there.
Huge. They basically said Boulder Canyon, which currently has about 49% ACV distribution.
So available in stores covering roughly half the country's grocery sales.
Right. They think it could become a multi-$100 million brand in just the next few years. That's a big step up from previous targets. Shows real confidence in that brand's runway.
Okay, so strong operational performance, market share gains, excitement around key brands. How does this tie into their strategy? Because they also talked a lot about transforming the supply chain.
Yeah, that's a major ongoing initiative, and it connects directly to those investments we talked about. They're actively consolidating their plant network, going from 8 down to 7 primary plants by closing their facility in Grand Rapids, Michigan. That transition is starting, well, basically now, August 2025, and running through early 2026.
And the goal of that consolidation.
It's part of a bigger plan to squeeze out significant productivity savings. They're targeting about 6% savings against their adjusted cost of goods sold.
6% is a big number.
It is. And while closing a plant and automating lines requires that higher near-term capital spending, which again is hitting the EPS, now management views this as a crucial structural move.
Making the network leaner, more efficient long-term.
Exactly. The idea is that this leaner network will eventually fund more brand building and route expansion, especially for those Power 4 brands. And importantly, they did confirm they expect 2025 to be the peak year for this capital expenditure. Automation is active now.
Peak capex in 2025. That's a key message for investors worried about ongoing spending pressure. Okay, looking forward then. What do they say about the overall salty snack market? And how do their ongoing investments fit into that outlook?
They expect the market itself to stay relatively flat, kind of sluggish overall. They do see some normalization coming in Q3, mainly because the comparisons to last year's promotional activity get a bit easier.
But their own growth guidance.
Right. Their guidance for 2.5% or better organic net sales growth for the full year, that's really built on the assumption that they'll continue to outperform the flat market. They're betting on their own execution, their market share gains.
And investments will continue.
Yes, they flagged that investments in things like sales, distribution, and SG&A will probably be modestly higher in the second half of the year.
Why?
Primarily to support the westward expansion of their direct store delivery system, getting their snacks directly to more stores, and also ramping up marketing spend for the peak summer selling season.
So it really paints this picture of a strategic trade-off, doesn't it? Management is clearly pushing hard on long-term efficiency, long-term growth, accelerating investments to get there.
Even though it's creating some definite short-term pain on the earnings line, that's the core tension here.
Which brings us to the investor context. Connecting this all back, that negative market reaction, even with the revenue beat and good gross margins, it just hammers home how sensitive investors are right now to that earnings translation. And leverage probably plays a role too.
Oh, absolutely. You have to look at the balance sheet. Utz Brands' net leverage is sitting at 4.1 times their trailing 12 months normalized adjusted EBITDA. That's not insignificant.
So 4.1x leverage. And these accelerated investments, they're hitting near-term EPS, and they're keeping leverage maybe a bit higher than investors would like.
Precisely. It puts pressure on both fronts. And if you look at the stock's performance, Utz Brands has significantly lagged the consumer staples ETF, the XLP, over the past year.
So investors are basically saying, we see the strategy, maybe, but we needed clearer signs of bottom-line growth before we buy in.
That seems to be the message. Management on the call sounded very confident about hitting their 2026 financial goals. They're talking 100 basis points of EBITDA margin expansion year over year in 26, double-digit EPS growth. Ambitious targets.
But the market's response suggests
The market's demanding proof. Tangible proof that these investments, this transformation, will actually translate into sustained earnings improvements. It really boils down to a key question for investors watching this.
which is,
Can Utz Brands consistently show that their productivity gains and their favorable product mix, selling more high-margin stuff like Boulder Canyon, can actually outweigh the headwinds from inflation and those higher interest costs?
that's the million-dollar question. So what are the near-term catalysts? What could shift this narrative? What should people be watching for?
Okay, a few things come to mind. First, execution on that Grand Rapids plant closure. They need to hit their timelines and, crucially, start showing those incremental cost savings they've promised. That needs to become visible.
Makes sense. What else?
Second, holiday season performance. How does sell-through look for their key brands during the big snacking periods? Strong performance there would reinforce the brand health story.
Okay, execution and sales velocity.
Third, more clarity maybe on the next earnings call about the 2026 margin framework. How exactly do they get to that 100 basis points expansion? And critically, confirmation on the future path of capital expenditures. Is 2025 truly the peak?
Investors want to see that capex number start coming down.
Definitely. And finally, just continued evidence of success in that geographic expansion, especially with Boulder Canyon and the other Power 4 brands. Sustained productivity gains showing up in the numbers. These are all positive signals, but their impact on EPS is what the market will be scrutinizing.
It's all about translating those operational wins into bottom line dollars right now.
That's the hurdle they need to clear in the market's eyes.
All right, that sets the stage perfectly for our not financial advice segment.
Yeah.
Picture this. We're in a hedge fund investment committee meeting. We've just listened to the Utz Brands call, the stock sold off on the EPS miss, and the guidance cut.
Yep, market's pessimistic.
But we see the underlying story. Strong, top line, growing margins, market share gains, that Boulder Canyon potential. How do we play this? What's the pitch?
Okay, IC meeting. Here's my pitch. I think we go long Utz Brands, but we structure it carefully. We use options to manage the risk and express a specific view, medium term.
Intrigued. Let's hear trade idea one.
All right, trade idea one. I call it the productivity play. We establish a core long equity position in Utz Brands, but crucially at the same time, we sell some out-of-the-money put options.
Okay, selling puts. Which ones?
Let's target an expiry date around the time of their Q4 2025 earnings call, maybe early 2026.
The logic.
My thinking is the market is overreacting right now to the short-term EPS hit from these investments.
Yeah.
It's ignoring the deeper structural improvements happening with the plant consolidation and automation.
You think the narrative shifts by Q4?
I think by the Q4 call, management will have concrete data on the Grand Rapids closure progress and hopefully tangible evidence of those initial productivity savings hitting the numbers. If those savings start to materialize as guided, and especially if they reinforce that 2025 was peak capex,
Then the market might start believing the margin compounder story again.
exactly, the stock could re-rate higher as that narrative gains traction. The put premium we collect from selling those options gives us a bit of a buffer on the downside if the market stays skeptical short term. It lowers our effective cost basis on the long stock position.
And if the stock does fall further and the puts get assigned,
Then we're okay acquiring more shares at that lower strike price because our core thesis is based on that long-term operational efficiency improvement. We'd see it as buying more at a discount, confident in the 2026 outlook.
okay, the productivity play. Long stock, short puts, betting on execution proof by year end. What's trade idea two?
Trade idea two is a bit more aggressive. Let's call it the Boulder breakout. This one uses call options, specifically a long call spread, maybe looking out 12 to 18 months.
A call spread. Buying one call, selling a higher strike call. Why this structure?
Because I think the market is seriously underestimating the growth potential of those Power 4 brands, particularly Boulder Canyon. Management wasn't shy about talking up its potential multi-$100 million big ACV runway. That's a strong signal.
So this play focuses more on the top-line growth story.
Yes, and the premiumization aspect. We buy an in-the-money or near-the-money call to capture the initial upside, and we sell a further out-of-the-money call to help finance the purchase and define our maximum profit.
And the catalyst here is Boulder Canyon delivering.
It's Boulder Canyon continuing its expansion, gaining more ACV, showing strong velocity in stores, and driving substantial organic net sales growth for the whole company. If that growth starts to really outpace the drag from depreciation, amortization, and interest.
Then the EPS growth could surprise to the upside down the road.
Precisely. This trade sort of looks past the immediate EPS concerns tied to the investments and positions us for when the market eventually recognizes the value of their strengthening brand portfolio and those market share gains. It's a bet that the strategic shift to higher margin brands wins out over the current investment phase narrative.
Exploiting the disconnect between short-term cost focus and long-term brand value creation.
That's the angle. It's about betting on that premium brand strategy paying off visibly within the next year or so.
Okay, two interesting structured ways to potentially play the Utz Brands story. So wrapping this deep dive up, Utz Brands Q2 2025 results. Really a nuanced picture, wouldn't you say?
Absolutely. You've got that strong revenue, the gross margin growth, clear positives driven by their strategic investments and market share gains. Good stuff happening operationally.
But right now, those positives are being overshadowed, definitely in the market's view, by that downward revision to the full-year EPS guidance.
Driven by those accelerated necessary investments in capex and the resulting higher interest and D&A costs. Short-term pain.
So while the market reacted negatively, focusing on that immediate earnings pressure.
Management remains, at least publicly, very confident in their long-term strategy. Supply chain optimization, geographic expansion, building those Power 4 brands. They believe these are the right moves.
They're betting these actions will ultimately deliver on those ambitious 2026 financial goals.
Right. It's a test of conviction versus current market sentiment.
And just a reminder to everyone listening, this podcast is purely for informational purposes. It doesn't constitute financial advice in any way. Always do your own research, your own due diligence.
Absolutely critical.
Thank you for tuning in to Talk Tickers. We always appreciate hearing your perspectives, so feel free to share your thoughts on Utz Brands quarter and their strategy.
Yeah, let us know what you think.
We'll be back soon with another earnings call deep dive.